Good day. It's Friday, December 10th. I'm Martin Gago with Market Radius Research. We've got CEO Jesse Douglas of Green Impact Partners joining us. Green Impact is a developer of renewable natural gas projects, RNG projects throughout North America with a $2 billion pipeline of potential clean energy initiatives they are pursuing. I've got Green Impact on the call today for several reasons. It's a news story. They went public just in June, and I want to understand this news story. It's focused on the RNG space, and we've had several RNG focused companies on the call this year. So this is hitting the sweet spot in the green tech, clean tech space. And the company is, unfortunately for them and for initial shareholders, they're trading off about 50% from when they went public. So while the whole RNG and clean tech space is off significantly, I think this stock could be a good deal at these prices, especially during tax loss season. So I want to poke around more and see what they've got going. And as well, they do already have some institutional coverage, giving me some additional confidence in the name. But remember, this is neither a recommendation nor investment advice. We're here to learn about the company, do your due diligence, and come to your own investment conclusions. Jesse, thank you very much for taking the time to talk with us today, and let's hear your pitch.
Thank you for having me, Martin. So a bit about Green Impact. We're here to create a sustainable, inclusive planet through the development of clean energy. Our immediate focus is on RNG, but we do have investments in hydrogen. We've got 4 facilities under construction there right now. Hydrogen refueling facilities with green hydrogen. We've got investments in water technology. We've got investments in other forms of clean and net zero energy. But we feel like RNG is the absolute lowest hanging fruit and a requirement to have done at scale and done now in order for the world to meet any of its hopeful environmental initiatives here in managing emissions.
Because, sorry, just like RNG or creating RNG from biomass type stuff, that's a well-established technology. There's lots of feedstock out there. There are incentives on this. So they're just a lot of sort of arrows are pointing to, hey, this is a good line of business right now, right?
We absolutely believe so. And if we get into like what is RNG, I mean, it's renewable natural gas, and it's effectively methane capture. So it happens from farm-based things, from anything organic that you throw into your green bin where you have it, or into your garbage can if you don't. Anything that is decomposing, it could be trees that fall in the forest or the waste from forestry. Everything that's decomposing is creating methane. That methane is seeping into the environment at an initial rate of 127 times worse than carbon or CO2. And in a 100-year effect, it's still more than 20 times worse than CO2. So if we don't capture it now, that immediate add-on effect of being that 127 times worse next year, with the world's growing population and hopefully continuing to bring people out of poverty and bringing the middle class up, we know that we will consume more with all of that. So that's going to generate more waste, which is going to generate more methane, which makes our carbon reduction goals harder and harder to reach. And as that population gets into the middle class, we know that historically they've always burned more energy. So why not take that waste methane that's seeping into the environment, capture it, and turn it into energy? So it's somewhere between 20 and 120 times better for the environment to do that. And you're taking an energy source that's now renewable.
Yeah, because just to clarify, you take the methane, you burn the methane, and sort of burning hydrocarbons isn't a good thing, but methane does such a bad thing to the atmosphere. It's way better to burn it than to just let it go into the world.
Yeah, absolutely. I mean, ultimately, so if you were to take, and that's why you see a lot of landfills just flaring their methane gas off, is because that is 127 times better than letting it seep into the atmosphere. We feel like it's immensely better if we stop extracting gas and replace it into the gas grid and burn it that way. Now you've got an add-on effect that you don't have the impact of oil and gas activity and the associated carbon emissions that come with that. So it actually is, when you consider the replacement and comparative value, it's better for the environment to burn this methane in an energy source than wind and solar have as an impact on the environment, because wind and solar still require some environmental impact to build and to use the products that are there. And So when you consider all of the alternatives, this is somewhere between 5 and 50 times better, depending on your methane capture and how well you build your facilities, than wind and solar.
Yeah, and when you, instead of just flaring it where the heat goes into the atmosphere, you can actually use that energy to heat a home or drive a car or produce electricity, then that's way better, right?
Absolutely. And little tidbit, compressed natural gas, not even burning RNG, just a regular gas car in California, sorry, not a car, a transport truck, has a carbon emissions of 0.02 effective tailpipe emissions. That same truck running electric through the grid is 0.07. So there are a lot of great technologies right now that can make a massive difference, that if we educate ourselves on and we do the right thing, and we really measure kind of the down to the molecule how effective we are, down to the neutron from an electricity perspective, how effective we are, we can make a big difference.
And that sort of energy measurement you referred to in California, that really depends on their grid, where they're getting their electricity from. In certain regions, it could be way higher if they're burning coal, or if you're in BC or Quebec and it's all hydropower, then it's super low, right?
Yeah, it is still, I mean, even when you take the full carbon intensity, even in BC, I think that same electric truck in BC is at 0.05. So when you consider even an ultimately really clean grid, there's a carbon impact. Cement and steel are the largest carbon emitters in the world, really. And you can't build a dam without cement and steel. So there is a carbon impact to everything we do there. And we've got to start really making the best choices. And I'm not arguing that RNG is the best choice forever for us. We certainly need technologies to develop. But if we don't do what we're doing with RNG, we will have no hope of meeting our carbon our carbon goals for the environment as a society.
For sure. And there's no single silver bullet for carbon and all that. We just, all over the whole sort of global supply chain and everything we're doing, we've got to tweak it, or more than just tweak it, substantially change it on all sorts of layers.
Better every day, right? Use the technologies we have today to be better, and continue to invest in innovation and additional technologies, so that I mean, if we solve the issue of fusion tomorrow, we're pretty good. I don't see that happening, but we do have to continually get better with technologies, including RNG technology, including solar and wind, and hydrogen. Everything we're working on today, we've got to get better at, and hopefully soon we come up with a new amazing energy innovation that really drives us forward.
All right. Well, I think we did a great little segue here on RNG and that. So let's get back to the main plot line, so to speak.
Yeah, absolutely. So we are, I mean, for us, like you did mention, and appreciate that, we've got a $2 billion growth pipeline, and those are controlled projects right now. We're working on nearly $5 billion of projects that are in the earlier development stages. This $2 billion is, some of it's under construction today, and we expect by the end of 2023 that this entire pipeline is either constructed or under constructed right now, and we've added another $1 billion into the near and permitting stage each year along the way. And that's a unique thing for us, in that we've actually been able to create an RNG portfolio that has scale. Most of the projects you see from our peers, and they're doing a great job, and we think everything they're doing is extremely important, and most of them are great companies. Probably all of them are great companies. But really, they're looking at projects that are somewhere between kind of $2 and $10 million in EBITDA or cash flow. And we're looking generally right now, we've got some projects that are in excess of $250 million in cash flow. Again, all with proven technology and technologies that we control. So the unique thing for us is that we've been able to find a way to develop RNG projects at scale, and scale from a world scale, not just in North America. We have our largest RNG project at 11,000 MMBTU per day is about 5 times bigger than anything else proposed or operating in North America today.
And when you say a $2 billion growth pipeline, like pipeline is not sort of an accounting standard. What do you mean by pipeline? These are projects you're bidding on, or that you've already won, or what do you mean by that?
Well, we're a developer with a build, own, and operate strategy. So these are projects we own. We own the land, we own the technology, we own the feedstock, and generally we own an offtake into them. So if you look into 2021, where we've got, we think an implied equity value today, based on what our asset base would be liquidatable for, of about $300 million. When you compare that to $100 million current traded value. We think there's some built-in built-in value there. But as we move into 2022, again, we own these projects, and the value that we can sell them for on the market, if we didn't have a build, own, operate strategy, right now in 2022, we believe we could put over $800 million onto our balance sheet by just selling the projects that we have as they move through permitting and construction. So, and as that gets into 2023, 24, 25, you can see that we're looking at nearly $2 billion in implied equity value. And that doesn't assume that we're operating those projects and that's the cash flow coming through. That assumes that we developed them and sold them, which we think we're giving up a lot of value in doing. And so, yeah, it's a pipeline, like you say, is not an accounting term, but these are projects that are owned by us, with land controlled by us, technology controlled by us, engineering done, and either in the construction stage or moving through permitting to construction stage right now.
So these are projects you can, you have a pipeline that you can build, like after you invest in them, after what, out to 2025, you'd have $2 billion worth of projects there, given some
$2 billion worth of equity value. The total project value through 2025 is about $3.5 billion.
Okay. And how much money do you have to invest in those projects to have that 200 or $2 billion of equity in?
Yeah, so I mean, the money we have to invest in the stuff under construction today is already invested, so we don't need to take any real cash off of our balance sheet, maybe a small amount to build what's under construction today. And then we've got some unique project partnerships with infrastructure funds where we don't actually have to put any of our own cash into these and maintain about a 70 to 75% ownership stake. So the unique thing is we can build this $2 billion in equity without raising a dollar in the public market. We don't need any of that. And so you mentioned that you think that there's some value in the stock. We think it's we think it's a lot more than just where the stock initially traded at. We do have control over these, and we've got project partnerships. We will be, as we make our announcements and kind of the world sees what's there, I hope that they see the value that's there. But yeah, we don't need to raise a dollar onto our balance sheet, and effectively the value in these projects with long-term offtakes at net zero or net negative in many cases makes them so significant that we can maintain 70% without putting a dollar of money in.
All right. Well, I think I sort of maybe jumped ahead in the presentation. Why don't I let you go back to your flip?
Yeah,
here.
well, I mean, while we're talking about some of those projects, I'll just give you an example in it. We can jump around in the presentation. So Green Gas Colorado, this one's under construction right now with a target of starting our commissioning in mid this year. So this is producing gas. We've got this is fixed price EPC for us, so we've maintained all of our cost structure and control. It's about a $20 million EBITDA project with about $76 million invested. Total for us in cash that needs to go into it between debt and cash is around 90, including our debt service reserve and other things. And so we look at this project as really, really strong for us, right? We effectively have all of our money, our cash back. If we sold none of it, we've got all of our cash back in about 2 years to redeploy into new projects. It's got a carbon intensity of approaching -200, and it's got a 10-year long-term offtake selling into the LCFS and RIN market through California and the US. This project is really very similar to a lot of what's left in the pipeline. Projects ranging in the on-farm project, and so these are projects that have CI scores between 150 and -150 and 250. So we're actually, when you compare our carbon impact to what's happening in the world today, we're actually taking carbon out of the atmosphere, even if this gets burned in a vehicle at the end of the day. This is a life cycle measurement for us, and we sell this gas on a long-term offtake right now. This is a 10-year offtake with a 10-year extension on it.
With like this project, or I guess they're all sort of structured in the same manner. It's an independent sort of company, and you own an equity position in it. I presume you have some debt that goes into it. The debt really doesn't show up on your balance sheet, I'm thinking. It just shows up on their balance sheet.
It's non-recourse debt to us. As we consolidate, you may see it on our balance sheet, but it's non-recourse to the company. So this is only debt at this project level, and that's how we do everything. So there, we are a debt-free business today, and we intend to maintain that long term. Where we have all of our debt falling at the project level with no recourse to the other projects or the company itself.
So let's just like simplify it. And if this went bad for whatever reason and it went bankrupt, they could go after the assets of that project, but they couldn't go after Green Impact itself to recoup that.
Our company and our shareholders would have, other than the loss of cash flow that this would be expected to generate, no impact to them.
Okay. And just to clarify again, sir, all the debt that appears on your balance sheet is non-recourse debt. So it's part, you own 70% of a project, you 70% of that debt appears, I guess, on your balance sheet, but it's not really your debt per se.
Yeah. What would happen is that really, from an accounting perspective, not to get too technical, all of it would show up on our balance sheet, and then non-controlling interest that would align it. But there is no recourse to the business. And today, if you're looking at any debt that is on our balance sheet, that's just simply an IFRS calculation for building leases or in some cases our cleanup liability if we abandoned a facility and had to clean it up. That's the only thing that's showing up. There is no true third party debt in the business today.
Gotcha.
And then Project Wheatland. So this is another great example. This is a very scalable project. You look at about a 20-year offtake into the utility markets with these ones. So when you look at contracted cash flow approaching $200 million, this is about a $900 million spend for us. We will have a project on this. The Colorado project, as you mentioned, we currently control 100% of or 99% of that project, with farmers and partners owning that 1%. As we get all our money back, they will own a little bit more through a waterfall. But we control all of that. We do control all of this, but our intention would be to sell about 30% of it to provide the capital to build it. And so we need no capital to build this $900 million project, which will produce 11,000 gigajoules a day and around $200 million in cash flow for us on completion. We're aggressively moving through permitting right now. Design is substantially underway, and we have PCL will be our contractor for this, and we've got a very, very healthy budget within that $900 million that we believe will actually bring down. So quick math on that is that we've got a 30+% return on equity on it. And again, it's producing fuel in a massive amount, the largest, 5 times larger than anything proposed or under construction in North America today, at a carbon intensity score that is the cleanest of, compared to wind and solar, it is cleaner than anything like that. So we have found a way with technologies we control to do RNG and do clean energy at scale with long-term contracts and predictable cash flow.
And is this a good time? You talk about you have internal technology that you guys have, because you have done a deal with Greenlane, who we've had on the call here as well. So are you taking other people's technology, then adding, I don't know, your own secret sauce, so to speak, to it as well? Yeah. What is your technology, or what value add do you have?
Yeah, Greenlane's an amazing partner, and we do stack technologies like that. And then we've got some technologies ourselves in the digestion process or the processing of certain feedstocks that we control. So it's all about kind of what your facility is, right? You can, I don't want to say you can't do a digestion facility that accepts absolutely every facility feedstock. You can, but typically when you're the technology to make sure that they work really well at capacity with multiple feedstocks is not really there right now. So yeah, we're using a stack of technologies. This one in particular is using 5 stack technologies. Some of those that are ours, and potentially Greenlane we have not awarded, but certainly like them as we do like them as a partner, and they've been very good to us in past projects. So yeah, and when you look at, for us, we are really driven around significant and sustainable and making that environmental impact. So it's really important for us, and that's how we drive the metrics and evaluation of our expansion projects and acquisition opportunities. If it's not significant and sustainable, we don't touch it. It really just is not a part of what we can do. It has to have late stage improvement technology. So everything we're using is in operation somewhere right now, or we've built the development and pilot facility with it, we know it works. We know we can insure it and wrap it, we're not playing a science game with the projects we're building. Not that we are not investing in new technologies. We are. We do spend typically around 5% of our dollars into new technologies because we think that's an important initiative in developing clean energy. But that's not. We're not building projects that are not with proven technologies. We have in-house expertise. When you look at our team of now nearly 100 people, we have some of the best in class developers, engineers, and operators that are there, and we have been extremely committed to full ESG principles in that we've got gender diversity, gender and equality through, and not just from a gender perspective, but from a racial and background perspective. And what we think that does for us as a company is certainly drives the ESG side of things, but more importantly for us, it drives diversity of thought and makes us even better. So it's a commitment for us on the ESG principles, and we need to know that when we're building a project, we have the ability to manage it. And then we get to the financial metrics, and we really are focused on driving best-in-class returns by controlling technology, stacking them, and getting things to scale. And so when you can get a long-term contracted project that has a 30% return, I don't know that there's anyone in the business that is doing that today.
Well, and I think a lot of people forget they use ESG as a code word for green technology, but it's environmental, what is it, social and governance that are all involved. So it's just sort of, it's a good business, it's sort of in a whole wrapper. It's not just being green. Without
a doubt, yeah. And when we look at the governance side of things, we've got an amazingly powerful board who are engaged. They wrote checks to be a part of this company. Management and board own more than 25% of the company. And I can say that certainly for some of us, myself included, we are buying right now. We believe this that where the stock is priced is an opportunity. I think I bought over 20,000 shares this month. And then our board is the same. And if you look at their backgrounds, they are extremely great governance and investment professionals who are also committed to all of the ESG principles. So super excited to have assembled a board like this that makes the impact that they do in our company and on the world through their investment and the time they spend on other boards as well. And so that for us checks our box for the G side of things. And if you look at the people on this page, we're committed to the S side of things. That flows through our entire organization, and everything we do is based on making an environmental impact. So we really think that if you're looking for a pure play ESG investment, we're that. And we also think, I would argue that investing in a new company that's bringing new technology or proven technology and pushing it into scale has a bigger environmental impact than buying shares of someone that's got some existing solar and wind assets, because we know we need more energy. We need to displace fossil fuels wherever possible. And for us, we're putting your money to work in a great way and making a bigger environmental impact by producing new energy. So we think the time is now, and that you make a big impact by investing with us. When we look at our business model, we really are through idea generation, early stage development. And right now, when we talk about that pipeline, that pipeline, before we consider it part of what our disclosed pipeline at it has to be pretty much through at least the early stages of engineering. We have to know that this thing is feasible. We have to know where we're going to sell and put the energy to for the financial economics. And we're already moving to kind of financing, funding, and permitting before it gets into what we consider our $2 billion pipeline. And then as we move to final investment decision, that's really where you're going to see it under construction. We almost always make final investment decision at the construction stage. Can't say for sure always, but almost always. And that's we then move to construction, completion, development, and the operations and community impact there, which are very important to us. We make sure that we are reinvesting through our ESG principles in every community that we have operations and offices.
Could you, because with these kind of projects, I always get a little confused with them because they're investors in it, there's the operator, there are all these different kind of parties working through it. And this is great, this flow chart here, but can you just walk us through each step of this just a little bit? Like idea generation is some dairy farm somewhere phones you up and says, hey, we got a lot of methane here, or like, can you
Yeah,
how does that sort of biz dev, the first stages
yeah.
kind of work?
Typically it's our boots on the ground, and we've got people in many of the states, certainly not all states are farm states that would justify it, but where we've got people in many of the states from Hawaii through to Nebraska, and we will typically be knocking on their doors to say, hey guys, we've got some technology and some will and some cash, and we want to build a facility with you on your site. What would that look like for you? And I can tell you this week I visited Nebraska, Iowa, South Dakota, and Colorado, visiting with farmers that are either in the early stages of partnership with us, where we've signed LOIs, or in the late stages where we're working through that early stage development and siting and figuring out what our permitting process might be, and deciding on our technology partner. So that's for us, the idea generation is us reaching out to farmers and figuring out how we can do something there, right? And not, unfortunately, every site works, and not just from a financial perspective, but sometimes where the farm is located and what they're doing, by the time we're done with a project, it doesn't have enough of an environmental impact for us to justify it. And so then we don't just drop it. What we'll do is we'll encourage that farmer. We'll try and find partnerships elsewhere where we can adjust what they're doing and help them, because I think certainly from food and farming, if we can't reduce the environmental impact that it has, and we're going to produce more, we're in trouble there too, right? So we want to make sure that we're making an impact there. As we move to engineering, we've got in-house engineering, and we've got great partnerships, long-term partnerships with external engineering firms that we kind of co-decide what we're doing. And financing and funding, our financing team, led by Kathy Bolton, our CFO, has raised billions and billions of dollars in the market in fashion of partnership and non-recourse debt, and they continue to do that for us today. So we do most of this stuff in-house and move to final investment decision. And then we've got our construction professionals, which are managing construction with our EPC contractors. And then we take our operations group, and through the process, about halfway through, typically we will start putting our operations team on site, and they will begin to start the commissioning process for themselves and operate the facility. Oh, sorry, Mark, you're on mute.
Yeah, thanks. How small of a project or how big of a project do you do, or do you have sort of a sweet spot, or does it really depend on what your offtake prices could be and the structure of the like the biomass where you're getting it from? Could you talk about sort of the sweet spot? Or
yeah, I don't know that there is a sweet spot. I mean, certainly certain types of technologies don't work at small scale, but going too large, if you don't have a controllable feedstock that you can put in there, would be a risk to the project as well, right? So it's depending on the feedstock, the location, and the technology you're using, it really ranges from as small as a $25 to $30 million investment for us, to the largest stuff we're working on today is about $1 billion. So it's a massive range.
okay, and when you say like what the smallest, what, $30 to $40 million, is that the whole project cost, or is that how much you would kind of put into it?
No, that's the project cost.
Okay.
That's cost. We have invested as little as $2 million into things to be a partner, right? Where we're partnered with a couple of others in the hydrogen side of things, and our investment there, I think, was a few $1 million. We'll probably put another few $1 million into it after we build the first 4 facilities here, and we've got, I mean, that again, a business that we've got long-term take-or-pay contracts with the trucking industry to produce hydrogen, green hydrogen, and where it's making an environmental impact, truly green, and can be certified green, which I don't know if actually just certifying green is enough. I do think that we have to certify how green it is and really what that total impact is, but not every country and every state is at that stage yet. Some are green light or no green lights, and so at least we're doing something.
And with you talk about hydrogen. Is that basically, instead of taking methane and pumping it into a pipeline, you process it one step further and pull the hydrogen molecules out of the methane, so then you've got a pure hydrogen? Or is this some other kind of electrolysis process you're working with?
Both. Yeah, both. So we do gasification, which then takes it to hydrogen and oxygen if needed, or we can stop it at methane, and we also do electrolysis for the hydrogen side. We do think that investing there, for us, the reason we're making small investments there is we think it's a little ways away from total rationalization and adoption, and so we're trying to find the spots in the world where it actually makes the most sense today, and we can learn best lessons in how to make it both environmentally impactful and profitable. And it's important technology, we think, for the future. It's not quite there today, where in North America, most of the projects we look at, even if we're trying to do it from a burning RNG or gasification further of RNG, or using wind and solar for electrolysis, we don't end up with in most cases, a positive impact on the environment to the degree that we get from just taking RNG and putting it into the system. So that kind of stops us, right? If we're making it worse, we don't want to do that. Where we're making it better and we can invest there, we're there, and then we take it. If we look even one step further, we're not financially impactful to do hydrogen currently in North America, or green hydrogen, but we will get there, and we think it's important.
When you talk about hydrogen investments, is that investments in hydrogen technology or hydrogen projects where you?
Both. So we invest in the technology, and we always look to have a project. We generally don't look to just invest in technology. If we don't have a thought of where we're going to put a project and how we're going to manage that, then it's probably not the best spot for us to be spending money yet.
And when you say investing in technology, does that mean you're like a venture capital where there's a little company with some cool technology and you give them $1 million to help build it up, or you actually have your own R&D guys where you invest some money in, or what does an investment in hydrogen or whatever kind of technology look like?
Yeah, both. So we will certainly invest with partners that are developing technology and projects, where we have the ability to invest further and eventually have a significant or controlling stake in that business. But we also do have our engineering and development team is working on their own technologies as well. So and we are super excited about a gasification technology that we are working through right now, and we've also got some water technologies that we're working on, which are very helpful on the farms to be able to provide them back potable water without using a lot of chemicals. So if those prove out, we think there's massive upside for the environment and our shareholders in those as well.
Okay. And one of the, you talked about like assessing projects, whether they are like, how big of an impact do they have? You actually, is that code for ROI, like in a dollar sense, or is really the big metric you're going for is how green it is, and then it better have some positive ROI on it as well?
Yeah, it's based around how green it is. That's the initial assessment. Is this better than existing options out there, and is this one of the best options in the area? Right. Every area's got different requirements, right? If you're living in an area that is extremely in early stage of environmental improvement, you might be building coal. That gives us a lot more opportunity to make an environmental impact. Whereas if you're living on a grid that's already running very clean and has got great carbon capture overlay and is doing things, we've got to work a little harder to have an impact in those areas. And we're making no bones about it. We are a for-profit company. We are we are doing well by doing good, and we cannot build something that doesn't have a financial impact, a positive financial impact for us. And we're targeting returns above the mid-teens as kind of our lower end hurdle rate today. Although we don't have anything in that $2 billion pipeline that we talk about today that falls under, I think, 21% on an ROC.
Okay. And what you're doing is a big cash flowing kind of business. You have projects that have long-term things that are going to generate lots of cash flow, but you've also got growth opportunities. At what stage of this company's growth do you start paying a dividend and start becoming kind of a yield company?
Hey, that's tough to say. I mean, we certainly do believe that by 2025 we probably are generating cash faster than we're deploying it from an equity perspective. So by then it could be earlier. We really base that around, we wouldn't want to issue a dividend today, push cash out the door, and then have to raise that cash to maintain our development portfolio and our significant ownership stakes in our project. So the day that kind of tips, we will. Well, I mean, obviously, we'll see before it tips, but we will be likely doing that. I would suspect probably in the 2025 range, with the intention still of sanctioning between $1 and $2 billion in projects every year between now and then and after that. So as long as the growth is there, we wouldn't want to issue a dividend that forces us back to the markets paying fees to raise money because we put money out the door.
Okay, that makes tons of sense. You've got all these growth opportunities, so invest in the business. That's the best use of capital right now.
Yeah, and when we're getting 20 to 30% returns, we think that our shareholders' money is better left with us getting those returns than giving them a 4 or 5% dividend, which then costs us money. So when we're not doing that anymore, I mean, a dividend I think is a purely financial thing, right? It's not an environmental impact anything.
Yeah.
Or so when the math makes sense, we will put one on.
Okay, thank you.
Yeah, so just a real highlight to our development and construction leadership team here. Here are some of the senior leaders within them. And if you look at these guys, I mean, we've got projects developed that are over $1 billion. For many of them, they were senior VPs and presidents in large utilities. They've worked in banks and Big Four accounting. They've worked in conventional energy. The skill set here is absolutely amazing, and with over $30 billion in aggregate of projects built and operated, we would argue and believe really strongly that this team has a better background of expertise than any of our peers today.
How many employees, like, because you do have a lot of contractors and partners for engineers to design it and so forth, but then I'm guessing a lot of project management is in-house. How big is your employees or tightly contracted guys who work sort of primarily like?
Yeah, full-time exclusive contractors and employees is around 90-ish right now.
Okay.
And so a big team as well, and growing every day. We recently decided to invest a lot more into our development and engineering team on the front end to make sure that we could bring these projects to market faster. So what our original plan was certainly to do it a little slower and work through that. And we sort of said, you know what, guys, we've got a unique ability to do these projects at scale. We've got to advance them. We've got to invest heavier here, and we've got to move them through quicker. And so that was something that we canceled some of the smaller projects and some of the CapEx onto existing strategies. And to be honest, we did sacrifice some short-term cash flow because of it, because every resource is scarce, right? You can't assume that you can do everything all the time. And so by pulling the team off of some of those kind of improvement strategies, which would have added $10+ million a year in EBITDA to us, we are forgoing probably $20 million in cash onto our balance sheet over the next 2 years. But we think it gets replaced as we bring the one project that those people are being moved on to with $180 million in cash the following year. So the investment is the return is massive for our shareholders, and the impact on the environment is massive.
Could you mentioned a bit with your financial partners, because you don't fund the whole thing. You've got other guys who provide other equity or debt into it. Do you have sort of a portfolio or a stable of sort of your regular co-funders on this? And when you've got a project, you kind of circle back and say, hey guys, here's a new deal? Or is every deal you got to sort of shop it around and knock on a bunch of doors and that to find that your funding sources?
Without saying too much, because we have not announced anything on this yet, we do intend to be working with a more committed team that works with us going forward. We have done everything in the past on a one-off basis, but yeah, nothing has been announced yet. So I'll leave it at that. But the intention will be that it's a similar group to ease the time and stress that it takes us to look for someone each time.
And is there the like over the last 6-9 months here, the equity market for ESG RNG has definitely, like, it was very frothy, let's say, earlier in the year. In terms of green funds willing to fund these projects, is it a pretty flush market right now, or is it relatively easy to find the capital?
I mean, capital is never easy, right? Even if you're just mortgaging a house, you should do a good job of finding the best partner for you. But I would say it's very flush right now. There is certainly a very big push among the large capital holders, the pension funds, and the large infrastructure investors to green up their portfolios and to make an impact by investing in new projects. So we don't have a shortage of people knocking on our door to participate in these projects.
But at the end of the day, it's how much you're paying for that capital and trying to get it as efficient as possible. Like, they're different.
Yeah, agree with you. Yeah. But the quality of the partner and their true commitment to the ESG principles and to the environment is important to us as well, right? We certainly we want to do well by doing good, and that falls through every part of our business. We want to leave a positive impact on what's there, and so we don't want to work with a fund that really is purely just cash flow based, right? And so if we've got to pay 1 or 2 points more to work with a partner that is making a difference with the capital that they get back as well, we will do that.
Could you just ballpark what is the debt funders on these projects? What kind of rates do you have to pay those guys? What kind of rates do they need?
Yeah, it depends on the stage. So we look to be in the sixes at the construction stage, and construction debt is more expensive, right? We always anticipate that, and then when a project completes, where we have projects at scale, we can move those into the 4 or less range, right? And if we have them at enough scale, we can issue a green bond. So the debt side of things is very active and very available, and especially with large contracted projects like we have, where we can move to getting them rated, credit rated, and issue a bond on them. We have a lot of options there at COD.
Thank you.
Current market right here. This is even a little dated. I think the stock has fallen off a little since then. Like you say, probably tax loss selling. I'm surprised all the time. I think that if you're close with the story, I'm surprised you're not a buyer. Like I said, I am a buyer, and I certainly know enough about it to make sense of that. But yeah, you can see currently sitting on cash. We really don't have any meaningful amount of current or long-term debt. Those really just are kind of our accounts payable and environmental impacts and leases, things like that. No third-party debt or bank debt that's there. And if you look at our 2023 kind of EV to EBITDA, we think it's only 2.7 times, with most of our peers trading in a multiple of their revenue. We have produced continuous quarters always for us now. So back from going public into the 2 quarters before that, we are positive EBITDA and anticipate the same going forward. So we think we're in a unique spot where we're producing cash, not drawing on it, and we're traded at what I would argue is the lowest multiple of any one of our peers out there today.
And with your current $2 billion pipeline, to fund that yourselves, your requirements, do you have to raise any additional capital, or are you fully funded with your balance sheet and then expected cash flows to fund that whole pipeline?
Between our balance sheet, cash flows, and the partners, so giving up a small piece, we don't need to raise $1 of equity to get this to build the $2 billion in equity value of the project. So quick math, 2 billion over 20 million shares is $100 a share, right? Trading at 5 today. It's we have seen some of our peers move from 100 million to 1.5 billion dollars in market cap over 3 months, and I would be very surprised if at the point that this fully gets recognition, whether that's the day that all of the cash flow comes in on a trailing basis, or a few days or months before that, I would not be surprised to see this thing go up by 20 to 30 times.
All right. And Could you possibly go back to the market to raise some dough if you find a whole bunch of new projects that just require more sort of cash and more sort of heft to get into them? Or is the plan to sort of keep the cap structure basically as it is and just work that $2 billion pipeline?
I mean, we've done the analysis inside on our board and said we have access to cash. We can sell down small pieces of certain projects, and so we have access. We could put a couple $100 million on our balance sheet in a real short time frame if we wanted to, without doing too much and without raising anything into the cap structure, just by selling some small minority stakes in projects. So we know we have access to enough cash to build everything that's in front of us today, and our analysis says that it's dilutive for us to raise money today at anything less than, on today's dollars, at anything less than $50. So I would see it as unlikely for us to be going to the market when the other sources of cash that are there for us.
Okay. All right. Okay. Thanks.
Yeah, and so I'm not sure how much time we have left here, but really kind of anything you want to go through, I kind of want to say, like, the timing we think is right. You're investing in a company that's producing positive cash today. You're investing in a company that's committed to making an environmental, social impact, and every dollar that we put to work here is making a difference. And you probably have Tesla style returns in front of you. So we think that the call to action and it is now for us. We're buying as management and board, and we think that the opportunity for financial return is amazing to be partnered with some of the best in class ESG returns that are out there.
All right, we have some questions from the audience here, so I'm going to throw them out at you. Could you discuss how Project Wheatland can be constructed without raising any additional capital at the company level? I think we've kind of addressed it broadly, but I guess more specifically.
So ultimately what we will do is we will sell Project Wheatland, sell 25 to 35% of that to a partner. And if you take the conventional, let's use the highest end of the range for conventional contracted infrastructure investment in private equities. If you take that as a present value 15, the project has about a 37% return on capital employed. And so a PV 13 would allow the $300 million that we need to go into it from construction, or $260 million, but let's round up to $300 million. If we sold 35% of that, we end up with $150 million in cash on our balance sheet, and all of the equity provided by a project partner that would own 35% of the project.
What
we
have
don't
you
anticipate that PV 15 is the right number. Just use the highest end.
All right. What have you heard or seen that gives you confidence in the $800 million of combined notice to proceed equity value from your Colorado and Wheatland projects?
We've had inbound offers for them. So when we're showing those numbers, we know what we could sell them for today.
Yeah. And the market for these types of project equity holders into it, it's fairly liquid. There's a fair amount of buyers and interested parties.
Yeah, very liquid. We've seen some recent precedent transactions happen at a 6 to 7% levered return, where you're seeing projects selling in $300 and $400 million. And we've had some of those same guys approach us and say, we're buyers and this is what we think it's worth. So yeah, we know what it's worth because we could sell them right now.
Yeah. Okay. Sort of a little bit down the similar vein here. What gives you confidence in being able to execute and building on operating on your announced pipeline of RNG projects?
We've got an absolutely great team with experience doing this. Myself, I've built billions and billions of dollars of projects. We've operated businesses and projects that are the same as these with our team. We've got 6 operating facilities on the go right now. And so I think for us, with the committed partners we have and the in-house team we have, we see very little to us being able to execute on what's there today. We're in control of it. Our bigger risks are time, right? When we work through the permitting process at Wheatland, certainly we're being told by all levels of government that we're getting the red carpet service and they want to advance it as fast as possible. But permitting takes time. So could we get it done in 6 months? Potentially, but we're not telling the world that we are getting it done in 6 months today. We think that we're giving ourselves a little more time and making sure that if there are any hiccups, we're not over-promising and under-delivering.
On the permitting process for these projects, is there generally community support, or are there any stakeholders that tend to be against it? I don't know, maybe old fossil fuel like representatives, or any, or is there some sort of environmental angle where some groups are like, don't do it, it stinks up the neighborhood, or I don't know what?
Yeah, I don't want to tell you that everybody is in support of it, right? There's always a person who doesn't want something in their backyard, right? And we will see those on these. We didn't see any opposition as we moved through the permitting process on Colorado, and we didn't see any opposition as we moved through the other 4 facilities. We have not yet seen any opposition on Wheatland, but yeah, there is potential for it for sure. We think that what we're doing from an environmental impact perspective and how we're working to partner into the existing fossil fuel network kind of touches everything and provides a positive impact for everyone, but doesn't mean we won't see some opposition. You see opposition to wind, solar, and hydro as well, right? So we would be naive to think that everyone's going to love everything we're doing.
Yeah. At what stage through that so that sort of flow chart of milestones to get a project done, what is the biggest de-risking event? Is it the permitting that really that takes the biggest chunk of risk off of it, or the getting the financing and funding for it, or?
I actually think, financing and funding, we often have very early proposals, even before we've done selection of our technology partners, final engineering and pricing, because we're not using technologies that are unknown to lenders and funders. So we typically have a pretty good idea of what our budget is going to be based on the scale of the project early. But I think the kind of the final de-risking for us, not that we think permits are unattained or completely administrative tasks. They are. You have to be committed to working through them. But we're also not doing anything where we're getting national oversight on them that would require kind of energy board review or things like that. So we typically, if we've got support from the municipality and the state or province that's there, we feel pretty confident in the permitting process. So we find that the engineering, we effectively consider a project. We could move to FID typically as we're finishing the 30 to 40% engineering drawings on a project. And so both Wheatland, Colorado's under construction, and Wheatland is at that stage now where we have very high confidence in the budget from a best-in-class construction firm. We have all of the technology partners have committed to the different types of technology that are in there and how they're going to play together. We have a site locked up and we're moving through. So we believe that one is substantially de-risked today. And most of what's left is almost administrative before construction.
Right. Would you consider selling your current non-RNG operating assets in order to redeploy this capital into higher ROI RNG projects? Or just conversely, like generally, if you need to raise capital to fund a project, you sell off your lowest ROE projects or chunks of that to sell that off to put it into a higher ROE project?
Potentially. For the right price, everything is for sale. If we need money that we don't have access to in other forms, and we can get a decent return out of selling certain things, yeah, we would consider selling them. We're not particularly sellers right now. We do believe that the market's going to flow through to our stock, and we will have any access to capital in the future that we need that way. If the access to capital and partnering for whatever reason ran out, although we don't foresee that at all either, that it's a very robust environment, and we typically have people knocking on our door to partner with us as opposed to having to go out right now. So yeah, but everything, I guess, is for sale for the right return and focus.
Right. And can you discuss the performance of your current operating assets? Specifically, why have they, and this is them saying it, I'm not sure what your initial projections were, why have they underperformed your initial EBITDA expectations?
I actually don't think they have underperformed our initial EBITDA expectations. We canceled a lot of CapEx on them, and we shut a couple of them down as we were working through COVID to do other capital projects onto them and do some environmental work on them to improve their environmental impact. Right now, we turned them back on at the end of September, and they're performing right in line with where we expected. So yeah, I think when you look at the delay in production of EBITDA for them, as we moved through COVID and there were multiple shutdowns, we maybe have missed times kind of shutting some things down and doing some of the work on them. But with turning the two facilities off, or two or more cash flowing and production, largest producing facilities off until the end of September, certainly that would have hit our short-term results.
Why did you need to turn them off, and why did you restart them?
Yeah, we turned them off, and we reclaimed a bunch of land around them. We debottlenecked a bunch of stuff, so we reduced the environmental impact and the energy used by some of the pumps. We redid one of the interconnect pipes between tanks and wells, and so really you can't really, while you're doing that, keep the facility operating, right? You could kind of do a little bit, but yeah, so and that took, as often does, a couple of weeks longer than we'd anticipated. So we missed production through the last quarter, but when we turned them on, they immediately were operating at the new design capacity with backup demand for them, and the last couple of months of results have been very good.
Okay, so those were investments that increased the overall ROI or ROE on it, but just hindered short-term cash flows. But overall, it's a more valuable project after those CapEx improvements were put in?
Yep.
All right. And yeah, we should be wrapping things up here. And someone has asked this question, as I always wrap things up with, they say, what upcoming milestones, catalysts should be watching for? And yeah, like over the next 3 to 6 months, what kind of news coming out of the company?
Yeah, we'll keep regular updates onto the permitting process and the preparation for start of construction, and even the potential awards to our technology partners within Wheatland. And we will keep you updated as to the completions of constructions at different phases through Colorado. And I would expect you to see us announce additional feedstock lockup agreements and the start of some new projects over the next few months here.
Right. Well, with that, Jesse, thank you very much for taking the time to explain the Green Impact story. And yeah, thanks for joining us today.
Thank you very much, Martin. Really appreciate being with you.
All right. Cheers. Talk to you later.